Nalu FM Finance Podcast. Insight into the financial markets.
If our clients are successful, we're going to be successful. And we knew what we were doing was addressing a client need.
This podcast is powered by Vesta, the engine behind active management. Vesta is a Switzerland-based fintech startup that provides software for issuers of actively managed certificates to automate their value chain fully. Visit Vesta, VESTR.com to schedule a meeting with an expert and to learn more about Vesta.
Hello everybody, I'm here with Nick Parcharidis, Managing Director for Private Wealth Solutions at iCapital. Nick and I have known each other for a very, very long time, probably 25 years plus, I would say. Both of us spend a lot of time in structured products, but you have an extremely extensive career in structured products across many regions. And maybe you can take us a little bit through your journey and how you actually got into this space.
Yeah, thank you, Stefan, and thanks for having me on the podcast. My journey dates back to the early 90s, even before we knew each other at Citigroup in the late 90s. And it started post-business school at a time when the exchanges, the American Stock Exchange, the CBOE, were going through a period where they were losing market share to their larger exchanges, the New York Stock Exchange, and then later on ICE. And so they were very involved in business development. And I left a firm called Shearson at that time, which some of us on this call may not remember. And I joined a team at the American Stock Exchange, which one was the early pioneer for ETFs. Right, it was the early invention of spiders in 1992, the mid cap, later on the Qs. But along the way, I met my mentor there as well, who exposed me to derivatives and the first generation of structured products. And it was a very different world than it is today. We actually developed the market at that time by drafting a lot of the rules that were in place and parameters for the first generation of structured products in the US. Obviously, Europe was always a much more advanced market in that space, but we literally crafted the rules. There were only about 6 firms that were involved in the business at that time, and it was primarily an opportunistic business. I was primarily involved in creating indices and ideas and putting together issuers and distribution to eventually list and trade some of these early generation structured products. And then right around the turn of the century, right around the time of the dot-com crisis, emerging markets, I joined Citigroup at a time when you were in Citigroup as well. And that's when many of the firms were making decisions to make this part of their main core capital markets business. And I went there initially to launch their equity structured product business in the Americas. And that eventually led to a business in Latin America as well in 2005 when we saw the success we were having in the US market. Spent a number of years in Latin America trying to replicate that success, obviously a very different market. And then post-credit crisis in 2008, we eventually went multi-asset, where we were introducing equity and rates and so forth. And then later on, that led to a joint venture between our private bank and private wealth solutions, where I was running all product and strategies for our individual clients. And that was my corporate life. And then the big transition occurred in 2018, as you know, where I finally left Citigroup. We launched a new initiative, a fund business through an RIA. And then here I am at iCapital, where we migrated that business over to iCapital.
Yeah, I think you started when the bigger firms became bigger and bigger over time. And then you went back and basically took the dive and basically started your own business with colleagues. A little bit, what sort of motivated you and what you thought was the, the challenges and the experiences going big, very small, and then going back to something that's clearly in certain parts of the market quite a leader with iCapital.
Yeah, so a couple things motivated me. One was the group of people that I was joining, right? They all had a similar background at major banks and wirehouses running private wealth solutions businesses, both for retail and for private bank. So we had vast experience in knowing what had worked and then also what did not work. And so when we launched this new initiative, we thought we can build on some of the successes we had at the banks by addressing some of the headwinds that we had. We always knew we were growing the business, but we thought we could significantly grow it more and tap into some growing trends in the U.S. One was the growing trend for fee-based advisory accounts in the U.S., which were accounting for about 2/3 of all AUM. The second was the explosive growth we saw in passive investments as well. So those two key drivers. And then also, we were seeing what was happening in the mass affluent annuity space as well. And so all those things led us to take what we were previously doing and apply it with some additional bells and whistles. And so it was a more effective way to deliver these solutions. And ultimately, the most important thing of what I'm saying is I knew we could add value to clients. We always think of it from the perspective of if our clients are successful, we're going to be successful. And we knew what we were doing was addressing a client need.
Now, you mentioned also looked after the LATAM business. Is there significant structural difference between the US and the Latin American business?
I would say both structural, but also cultural, right? One of the things I learned back in 2005, and I was literally the first 3 years spending a lot of time in Mexico, Brazil, the Southern Cone, Chile, Uruguay, Argentina. In some ways, very similar to Europe in the sense that you had many different jurisdictions structurally with different rules and regulations and a different roadmap on how do you do business. Culturally, their definition of long-term and what we were used to in the U.S. market were very different. You didn't venture to issue anything that was beyond 18 months.
Wow. Okay.
And so that was considered long-term. And a lot of that has to do with, the political instability in many of those places, historically. The other thing that was very different is it was a market that had a strong bias towards fixed income. Right, bonds was their core holding, and so everything we were doing had to fit into a bond complement or a bond surrogate, a replacement. So no surprise, income types of structured notes that were shorter duration, where you could leverage the higher interest rates, played well in the LATAM region.
You touched on it a little bit. I mean, the key wrappers is sort of the difference between, you mentioned fully funded warrants. Is there other ones? I mean, I think the US particularly uses insurance-based solutions.
Absolutely. So in the US, you primarily have insurance-based solutions. You have notes as well, right? And then you have market-linked CDs, which also carry FDIC insurance. I mean, those are the three primary vehicles. You fast forward today, and it's evolved a lot, and I'm sure we'll chat about it a little bit later as we talk about innovation. But now you have ETFs and 40 Act UITs as well, which are delivering buffer-like solutions, for instance, in structured products. In Latin America, a key driver is also tax, right? So very important when you're issuing something into Latin America that you're doing it in a way where any income is going to be treated as income and not dividend, where they're being taxed at a higher rate. Right. And you can't have mass offerings that are registered. So you have to do it via a higher frequency of just Reg S offerings. And that really is important because most clients that are investing in Latin America have an onshore account and an offshore account denominated in US dollars.
Excellent. Let's start a little bit looking forward, sort of what we see as trends and sort of, I mean, maybe in the current environment, let's talk about that one a bit. Volatility is rising, interest rates are falling. Regulation is tightening in Europe while the US clearly is moving towards more deregulation. Then you have artificial intelligence, automated performance, how we price and sort of distribute, maybe manage and risk manage these structured products. The industry is evolving very fast. So how will you and, in that respect, iCapital adapt to that one?
Yeah, so I think the one thing that has changed significantly versus when you and I got into the business in the early 90s is platform and technology. So platform and technology has been key given how quickly markets are moving as it relates to volatility rates. I would actually say that what we're seeing here is record issuance because of a lot of what you just described. The market here in the U.S., I didn't think I'd see it in my lifetime, but literally year over year was up from 135 billion to about 200 billion, which is close to what we're seeing in Europe. It could be challenging at times, obviously, especially when rates are low and volatility, as you know, plays an important part in everything we do, right?
Now, I've seen similar things, the automation that makes it possible to have smaller sizes and also more tailored in that respect for the specific client because he can get his smaller slice. But also I find more and more connectivity to other platforms. These platforms are starting not only to be standalone anymore, but they also start branching out to what other ecosystems they're connected to, if they're getting ESG data or to custodians or exchanges and everything else.
There's no question, and we've spent a lot of time and investment in integrating our iCapital platform, where an advisor can come in on any given day, and we have something called Marketplace, where we have over 100,000 advisors who come there, and they can come there and access education and content and aftermarket support for traditional alternatives, whether they be hedge funds or private equity or credit, structured products from all the major issuers, and then annuities from all the carriers.
That leads me a little bit to my next question. I mean, we talk about alternatives, which can be anything from structured products, hedge funds, private equity or private market investments. How do you sort of deal with that and how you compare them, how you position them versus the client in terms of risk-adjusted returns or expectation management and education?
The way we kind of look at it here, if you step back, is that everything we do is an alternative. I mean, one can argue, obviously, that defined outcome structured investments, defined outcome annuities, I mean, they all have asymmetric payoffs. Some traditional alternatives are obviously actively managed. These are passive, but we start with that as a basic premise, right, on the platform. And also, it all starts also with asset allocation, right? Meaning that a complement to bonds and stocks, we've done a lot of work on beyond 60-40. In other words, traditional 60-40 allocations don't necessarily work, especially when we're seeing significant market moves during small periods of time. Like, for instance, Q4 of 2018, you have a sell-off not only in equities, but you have a sell-off in bonds. So it's asset allocation and letting people know, and here's some fun facts, there's actually more opportunities in the private space today than there are in the public space. So for instance, back in the 1990s, you had probably here around 8,000 plus public companies. Today, that number is a little bit over 4,000 companies, okay, versus private market opportunities where, for instance, if you look at companies that have an excess of $100 million in revenue, 90% of those companies are private, right? So the private market opportunities, in that sense, you have more opportunities to look at. And if you look at performance over a long period of time, typically they will have higher risk-adjusted returns. Now, the trade-offs are obviously liquidity and everything else. So we do a lot of education as to how to include them in a portfolio, the pros of adding them in asset allocation, and then understanding the liquidity, the higher hurdles, and everything else.
I mean, that's a really interesting trend, which is sort of another one. A question I wanted to ask is, if you sort of had to make a bold prediction about the future of structured products and alternative, what would it be?
Yeah, I actually think, Stefan, we're in the early stages. I like to say in the third inning. We've seen significant growth over the last couple of years. I think I read a number where AUM in traditional alternatives globally is, as of 24, I think it's about 17 trillion. And I've read studies where that, and I believe this, that will grow probably in the next 5 years to about 29 trillion. Right. And the reason for that is platform. So we use this concept known as democratizing alternatives. So a lot of education, making it easier for advisors to buy these alternatives, documentation. And then there's a lot of innovation in that space. So, trying to not only offer it to institutional clients or the ultra high net worth, but to high net worth as well, for instance, and lowering the hurdles in terms of what it takes to buy some of these investments. So I'm very optimistic about not only traditional alternatives, but also structured products, irrespective of market conditions, where even if rates go down or volatility isn't favorable to new creation, the reality is we can adapt, and you just have more usage by advisors, whether they be IBDs, RIAs, much more so, and fee-based accounts, as well as private bankers.
The beauty I find often about the structured products, if you speak about that one, is that you know very clearly if the market ends up where here or higher or lower, exactly what your payout is very deterministic. I think sometimes we didn't help each other very much with all our fancy names. And if you didn't grow up in that industry, you didn't understand what we were talking about. So I think that's the time. But how do you or how does iCapital help with all these thousands of your users on the platform to make sure that they are, where do they go into the overall portfolio of their client who also have stocks and other investments?
Yeah, so that's a great question, because you and I wrestled with this for years in terms of putting it in a portfolio context, and we're actually been rolling something out called Architect. And Architect's mission is exactly that: is allowing advisors to adjust their portfolio allocation to structured products which have an asymmetric payoff, to see how they can improve risk-adjusted returns. And so you see certain trends, and this won't come as a surprise, but plain vanilla growth plus buffer, limited protection on the downside, being used as complements to the equity allocation, for instance.
It's a defensive play.
Exactly, more defensive. And for those that want even more defensive, preservation ideas that have less upside, for instance, and more protection. And then you have obviously the income plays as well. So we try to categorize them in terms of risk profile, and then we have the tools to show how the different return risk matrix will change as you add these different type of risk buckets to an existing 60-40 portfolio.
I mean, iCapital came out of the US, but you're clearly expanding globally. And I'm particularly interested in Europe. Sort of, how is iCapital positioning itself to serve sort of more the specific needs of European investors when it comes to your business?
So we've been in Europe now since 2020, basically. We have about 300 plus people in Europe across 3 hubs: London, Zurich, Lisbon as well. We've rolled out our marketplace platform there, which allow advisors that are looking for global opportunities to go to the platform, for instance, and see where those opportunities are. But we're also working closely with wealth management firms in each, as you know better than I do, each of the jurisdictions, to make sure we're delivering solutions in local currencies and so forth that make sense for that specific jurisdiction. We'll be bringing Architect there as well very shortly. So we've been very active in the region. I think I mentioned to you before the call, I mean, to show you how serious we are, up until now, we've had brand ambassadors in the U.S. That were traditional U.S. golfers like Cam Young and Lexi Thompson. And we just signed on our new brand ambassador, Stefan Rojas, in Europe, from Europe, right? So we're serious about Europe, and there's a lot going on in there from an education standpoint, platform standpoint. And then lastly, most recently, we partnered with MPW Capital as we continue to expand our client reach and do more with clients in the Middle East as well, even beyond just traditional Europe.
Yep. Is it, when it comes to these investment opportunities that you show, is this more like you're bringing US product in the sense to Europe or vice versa? Or how do you approach that?
Yeah, that's a good. I think it's a combination of both, right? I think we're very cognizant of local rules and regulations which differ, right? And the way business gets done there as well. So oftentimes you have an intermediary that acts on behalf of the end client, like a nominee, right? So we are offering local product to local investors as well. I think there's only certain jurisdictions that allow for offshore product, but at the same time, we're acting as a gateway to U.S. product as well to make that available to European clients as well.
Yeah, I also suspect that in the Americas that business moves slightly faster than the European, particularly when I my experience in the VC space and private equity space. Another question, which is sort of a very generic one, and that is a little bit, you've been in this industry for a very long time, and I'm sure you will hang around for much longer, in many more years. But what is sort of your definition of success?
I think success starts with the client. We've seen it time and time again over, at least in my case, my 30 years, right? Where it's an ever-changing market, whether it be regulation, whether it be event-driven, like the credit crisis in 2008. And I think what's amazing about this industry, in particular these solutions, is you adapt to that, right? And you adapt in a way where you're actually making a difference in clients' lives, right? And clients defined as advisors and their end clients, whether it's meeting a retirement goal or some life cycle event and so forth. So to me, that's the most important thing.
A slightly more personal question is, what is at the top of your current music playlist, when you go home in the evening? Or
Yeah. So there are certain groups that I've been listening to for some time, and I don't deviate much. I must say that my playlist is very different than my 3 children who are now in their 20s, right? So I tend to be a little bit more old school. So I've always been a big U2 fan. I've always been a big Rolling Stones fan. So it tends to be rock, and it tends to be bands that have spanned the decades.
Excellent. That shows staying power, like you.
Yes, there's a little bit of a parallel there, Stefan.
So last question, if people liked what they heard and they would like to reach you, how can they reach you?
Yeah, so first of all, thank you for your time on the podcast. Always great to reconnect with a friend and a colleague who I've known now for 30 years. People can reach me directly, either at my iCapital email address, so nparcharidis@icapital.com, or via LinkedIn as well. Would love to chat, love to get people's feedback and thoughts, because I know a lot of your audience is in our industry and have some interesting ideas as well. So appreciate the time, Stefan.
No, Nick, has been great. Thank you very much for coming on.
Looking forward to seeing you next time you're in New York. All the best.
Nalu FM Finance Podcast. Insight into the financial markets.
This podcast is powered by Vesta, the engine behind active management. Vesta is a Switzerland-based fintech startup that provides software for issuers of actively managed certificates to automate their value chain fully. Visit Vesta.com to schedule a meeting with an expert and to learn more about Vesta.